Welcome everyone to chapter 16. In today's chapter, we are going to discuss a certain relief which is available in UAE Corporate Tax Law. As you all know, the Corporate Tax Law got implemented with effect from 1st June 2023. Prior to that, there was no corporate tax. Businesses were already having certain asset which they were holding from prior to the corporate tax, which either they sold after corporate tax or they are intending to sell after corporate tax. So this was always a question that should the business pay taxes for the full gain or loss. Let's see an example, to understand the entire concept of transitional relief. Let's say business purchased one asset. It can be any asset. It can be a tangible asset or intangible asset or financial asset. They purchased one asset in the year 2020. Let's say the value what they have paid is 10 million. Now this asset is with them prior to corporate tax. Companies following January to December as their financial year, that means they are going to be subject to corporate tax with effect from 1/1/2024. And their first tax period will be 1/1/2024 to 31st December 2024. Uh, like what happened was the company sold this asset in 2026, which they purchased for 10 million dirhams. They sold it for, let's say, 25 million. Obviously, what is going to happen? They are going to generate 15 million as a gain. If we apply depreciation for this asset, then the gain will go up. This is just for easy example. 15 million gain they got. Now the question is like this 15 million is taxed. The answer in short is yes, it is taxed, but there are some reliefs available. If the business want to make this election of this relief, then they are not going to pay taxes on the full amount. They are going to pay taxes on the certain formula we will apply, and certain gains they can exclude. We will discuss that in detail. So there is a relief, and this relief is called transitional relief, where it is explained in UAE Corporate Tax Law, Article 61 explain about the transitional adjustments what need to be made. So the concept of transition means a business is making a transition from no tax to tax. So what all adjustments they need to make? The Article 61 is telling that every business should make a opening balance sheet. Opening balance sheet means considering all the tax adjustments, they should create opening balance sheet, and so many things are there. We are focusing on transitional relief. So Article 61 is explained about transitional adjustment. Followed with that, there is a ministerial decision published, which is Ministerial Decision number 120 of 2023. This ministerial decision explain which all assets we can bring it under this relief, what are all the condition, how to calculate all these things explained in Ministerial Decision 120 of 2023. Now let's understand in detail how a business can avail these benefits. So there are certain conditions to get this benefit. First, let's understand what are all the conditions. Let's discuss the conditions to get the transitional relief benefits. Condition number 1, asset must be held or measured in the cost model basis. It can be asset or liabilities. It is held on the, or it is measured on the cost model. What is cost model? Where all we can apply cost model? We have discussed this thing, cost model can be applied for property, plant and equipment. Cost model can be applied for IAS 40, which is investment properties. Cost model can be applied for IAS 38, which is intangible asset. This all we have discussed in our IFRS lecture. The first condition is that the asset must be measured in the books on the cost model basis. Second condition, the asset they are holding prior to implementation of CT, prior to corporate tax. This is the second condition to be eligible for the relief. Third thing, the asset is either sold after corporate tax or expected to be sold, expected to be sold at gain. Either if you purchased one asset we discussed here no for 10 million dirhams, and you sold this asset after corporate tax for 8 million dirhams, there is no gain. Then you don't need a relief to avail. Obviously, there was a loss. The question will come here only when it comes to there is a gain. That's why the condition is that either the asset is sold after implementation of corporate tax or expected to be sold at a gain. This is the third condition. Fourth condition, the business should elect. The business should elect. When they should elect? In the first tax return. Regardless they sold the asset or they are planning to sell the asset, if they have any assets in their books which is measured at cost and they are holding it prior to the corporate tax implementation, either sold or expected to be sold at gain after corporate tax, they need to elect it to get this relief. They need to elect it through their corporate tax return. In which corporate tax return they need to do? In the first corporate tax return, what they are doing, in that they need to do. And when we are talking about election, again, election is optional. And there are two types of elections which we have discussed again multiple times: revocable and irrevocable. And certain elections can be revoked subject to the conditions also. This particular election, transitional relief election, it is always irrevocable. You need to elect it in the first tax return. If you forget, you forgot to elect, then the relief is gone. When you sell, or if you have already sold after corporate tax, you have to pay the taxes on the full profit. So the election is irrevocable and it required to be done in the first tax year. Now let's understand what are all the assets which are eligible for this transitional relief. Let's broadly divide it into three categories. First one is immovable property. Immovable properties are eligible for transitional relief. Second thing, intangible assets. Intangible assets we discussed, the assets which cannot be touched or seen, like we discussed software, copyright, patent, all these things we have discussed. Third thing, financial assets or liabilities. When it comes to financial assets, the ministerial decision explained that it can be either financial asset or financial liabilities. But when it comes to immovable property, they didn't tell the loss from immovable property or the intangible asset gain or loss. It's always for the immovable property and intangible asset, the gain, whatever they got or they are expecting to get, can be excluded if they make this election. But when it comes to financial asset, it can be financial assets or liabilities. These are the three types of assets which are eligible for transitional relief. Now let's discuss one by one. Immovable property. Immovable property can be any property, like it can be investment property, it can be property, plant and equipment. If the property is an immovable property, then first, what is the first condition told? It need to be valued at cost and it is holding prior to corporate tax. And third condition, either sold or expected to be sold at gain and election made. These are the four conditions. Now, when they are making this election, they can do it in two ways. How they can make election? First election is direct method. This we are discussing only for immovable property. Intangible assets and financial assets and liabilities we will discuss subsequently. Second one is proportionate method. These are the two methods business can use to understand how much gain they can exclude in their corporate tax return. What is direct method? In direct method, it's telling that, okay, let's understand it through an example. The same example we will take, business purchased a building Building is immovable property. The business is measuring this asset cost basis. Building they purchased in the year 2020 for 10 million. Now, like where the business is following January to December, so their first tax period is 1st January 2024. 1st January 2024. Have they sold it? No, they have not sold it. Do they need to elect regardless they sold or not? Yes. First tax return, this election required to be done. Then only when you sell it, you can avail this transitional relief. So they have elected it in the first tax return. They are using the direct method. So what they are going to do, they are going to see the market value of the property, this building, as on 1st January 2024. They are going to calculate the market value. How they will calculate the market value? Yes, there are approved valuers or agencies who can do this valuation, and they are going to approach these people and tell that, hey, this is my property, this I have purchased in 2020, and my corporate tax is starting 1st January 2024. I want the value of this property as on 31st December 2024. So let's assume the valuer give a valuation of this property 20 million. 20 million is the value of the property through valuation method. Now we are trying to understand, okay, now we need to see in 2026 the property sold for 30 million. And the business is now trying to avail this gain. If you are seeing this building like 2020 they purchased, when they are doing it in the cost model, what is the another point what we need to understand? They must have applied depreciation, because in cost model it is cost minus accumulated depreciation minus accumulated impairment. They must have applied depreciation. Let's assume that the depreciation what they charge every year was 5%. What will be the net book value in 2020? It is 10 million. 2021 the value is 10 million minus 5%. So it is 500,000 dirhams is the depreciation, and the net book value is 9,500,000. In 2022, again they charge 500,000 depreciation, and the value will be 900,000. Sorry, 9 million. 2023, again the business has charged 500,000 depreciation, and the value is 8,500,000 dirhams. So this is the net book value 31st December 2024. This will be the opening value as on 1st January 2024 also. Now we have multiple figures here. What are all the figures we have? We have purchase price. How much is the purchase price? Purchase price is 10 million. We have the valuation done from the approved valuers. What is the valuation amount? 20 million. We have the opening net book value. What is this valuation date? Valuation date will be 31st December 2023. Why we are taking 31st December 2023 valuation date? Because the business is following January to December as their financial year, and their corporate tax is starting from 1st January 2024. We have net book value. How much is the net book value? Net book value is 8,500,000 dirhams. This net book value is also as on 31st December 2023. Then which value we have? We have the selling price. When they sold the property, they sold the property on 31st December 2026. Let's assume they sold. And how much they sold? They sold it for 30 million dirhams. Now first we need to see how much profit will be showing in the books. In the books it will be sale value, which is 30 million, minus net book value, which is 8,500,000 dirhams, which is equal to 21,500,000 dirhams. This is the book profit. Now, as you know, if in books, if there is any profits are recorded, this profit will be coming for corporate tax calculation. Now, what we are going to see, applying this transitional relief, how much profit can be excluded from this 21 million 500 or 21.5 million. How much profit we can exclude? This is what we are going to see. How we are going to find out the gain which is excluded using direct method? First, we are going to see the opening value. How much is the opening value? Opening value is, we got is 20 million. From where we got this opening value? We got this opening value through the valuation what we have done through the approved valuers. From this, we can deduct higher of two things. One thing cost, second thing net book value. How much is the cost the business is incurred? The business is incurred 10 million is the cost. How much is the net book value? 8.5 million. Which one is higher? 10 million is higher. So from 20 million, they can reduce higher of cost or net book value. How much it will be? 20 million minus 10 million, which is 10 million dirhams. This 10 million dirhams is called excluded gain. From where it is excluded? It is excluded from calculating the corporate tax. Now, how much is the profit the business got as per books? They got the profit of 21.5 million. And when we are calculating the corporate tax, it will be like this, that the profit, it's 21.5 million. Then excluded gain 10 million. Then taxable income will be 11.5 million. That means out of 21.5 million, they are excluding 10 million. How they are excluding? Through electing this transitional relief. This is direct method. In direct method, what we have done? First, the property is purchased. The property is on cost model. So the business has have applied the depreciation, and they got the net book value on starting of corporate tax. We got that value 8.5 million. Purchase is 10 million. Which one is higher? 10 million or 8.5 million? 10 million. How much is the opening value what we got using direct method? 20 million. From where we got? We approached the approved valuer, and approved valuer gave this value that as on 31st December 2023, the value of the property, the market value of the property is 20 million. From this 20 million, we can minus either higher of cost or net book value. So we deducted 20 million, which is the revalued amount, minus 10 million, which is the higher of cost or net book value. We got 10 million dirhams. This 10 million dirhams is excluded gain. Now, when coming to corporate tax, the property sold for 30 million dirhams, and from 30, like how much the book profit will be? 30 million minus 8.5 million, which is sale value minus net book value. They got 21 million as a profit in the books, and from this profit they can exclude 10 million dirhams, which is we worked out as an excluded gain, and the taxable income will be 11.5 million. This is how for immovable property the direct method can be applied to calculate how much is the excluded gain. Now the second method is proportionate method. Business can choose either direct method or proportionate method. It is up to them. There is no restriction. When it comes to proportionate method, how the calculation is happening, that the business, the first part remains same. Like for example, when we are in the direct method, we told like we are approaching a valuation a person, like we are getting the opening value. Here where we are not doing that approved valuation or something. Here what we are doing, we are doing this calculation only after the property sale. So in the previous example, how much was the sale value of the property? Sale value of the property is 30 million dirhams. This we know the actual sale value. Now from this we are going to minus higher of cost, or how much was the cost? 10 million. Net book value. How much was the net book value? 8.5 million. Out of this, which one is higher? 10 million. So we are going to minus 10 million. We are going to minus 10 million, and then we are going to get the gain, which is 20 million. AD 20 million, this is the gain. Now, what we are going to do? We are going to calculate how much is the excluded gain. How we will use proportionate method? First, we need to see number of days property owned prior to corporate tax. Prior to corporate tax. When the property is purchased on 2020. How many days the property owned prior to corporate tax? Let's assume the property is purchased on 1/1/2020. That means 1 year, 2 year, 3 year, 4 year. 4 year the property is owned by the business prior to corporate tax. We got 4 years. If let's say we are calculating the 4 years into number of days, we will get 1460 days, which is 365 into 4, divided by total days the property owned. What is the total days the property owned? Property they purchased on 1/1/2020 and they sold the property on 31st December 2020. How many years? Sorry, 2026. How many years property totally they own? They own for 20, 21, 22, 23, 24, 25, 26. 7 years in total they have owned the property until the sale is happened. How many number of days? Again, 7 into 365. It is 7 years. In number of days, it is 2,555. Now what we have the sale value. From sale value, we deducted higher of cost or net book value. We got the cost is higher. So we deducted, we got 20 million as a gain. Now from this gain, we are calculating prior to corporate tax how many days the property hold, were held, 1460 days. Until the date of sale, how many days the property held? It is 2555 days. Now we are going to work out the excluded gain. Excluded gain, the total gain is 20 million. This 20 million we need to multiply with number of days the property owned prior to corporate tax divided by number of total days the property is held. How much it will be? 20 million into 1460 divided by 2,555. It will be 11 million 428,571. This amount is excluded gain. This amount is excluded gain. Now again we are calculating how much is the book profit. Book profit is nothing but sale price. How much is the sale price? 30 million minus net book value. How much is the net book value? 8.5 million. This is the same we have seen in the previous example. How much is the book profit? 21.5 million. From this 21.5 million, they can remove the excluded gain. How much is the excluded gain we calculated as per the proportionate method? It is 11,428,571. It will be 10,071,429. Now here, when we use the valuation method, we got the taxable income 11.5 million. Here when we use the proportionate method, we got the value which is 10,071,429. Now the question is like, which one you will choose? You want to pay taxes on 11.5 million or you want to pay taxes on 10 million. It is on you. You can either choose direct method or you can choose proportionate method. On a practical scenario, we need to calculate when we are coming across in your professional, tax filing, when you are doing for your clients or for your business, you need to evaluate both the situation. First, you need to check what was the market value on 1st January 2024 or 31st December 2023. Then you need to calculate on proportionate method. To calculate proportionate method, you don't need to go to any approved valuer. Then compare both the things. Where you are getting more gain, go with that option, direct or proportionate method. So this is about immovable property. In immovable property, the business can choose either direct method or proportionate method. In direct method, how the excluded gain is calculated, that we have discussed. In proportionate method also, we have discussed. Now comes the second type of asset, which is intangible asset. In intangible asset, most of the things so far, if you have understood on the immovable property, intangible asset is very easy to understand because the treatment more or less is same. Only a few changes, only what we will discuss here. First thing, in intangible asset, there is only proportionate method. So if you are having any intangible asset, which you have kept it on cost basis, which you own prior to corporate tax, which you sold or intending to sell at a gain after corporate tax, and you have elected for realization basis relief, then you can get a transitional relief for intangible asset. There is no direct method, only proportionate method. Proportionate method, we have already calculated how to calculate the proportionate method. First, you need to find out how much you sold, because proportionate method you can apply only after you actually sold. Direct method, even if you have not sold, you can still calculate based on the valuation. So how much you sold, you need to understand that. And then for the intangible asset, you must have applied cost minus amortization. Cost minus amortization, you must have got net book value. Then minus the sale value, whatever you sold the intangible asset, you can minus the higher of cost or net book value, you will get the gain. And from this gain, you are going to see how many days you owned this intangible asset prior to corporate tax and how many total days you own this intangible asset until the date of sale. And you are going to apply the formula and you will get the gain, and this gain is excluded gain. And you are going to calculate sale price minus net book value, and from this sale price minus net book value, you are going to minus the excluded gain. So this is how you need to calculate intangible asset. Second point in intangible asset, we told what if the intangible asset, if the business has an intangible asset, let's say they purchase this asset in 2020, let's say the asset is purchased in 2005. Now in 2025 or 2026, when they are selling this asset, how much gain they can exclude? Here they have told for intangible asset one limitation. You told maximum you can calculate 10 years only. 10 years only. Where this 10 years you can calculate? You can calculate on the here number of days you own prior to corporate tax. Here you can maximum take 10 years only. If it is more than 10 years, you should limit it with 10 years, and the denominator will be total number of days the intangible asset is held. Let's try to understand it through an example. Let's say the company has a profit before tax. From where we will get profit before tax? From our P&L. Are we considering OCA items here? We are not considering OCA items here. They have a profit of 500,000 dirhams in the books, and they have purchased an intangible asset in 2011. Let's say 1st January 2011, the business has purchased the intangible asset, and how much was the cost? The cost of the intangible asset was 100,000 dirhams. Life of intangible asset, they worked out 10 years. 10 years. If it is 10 years, how they will be depreciating this asset? They will be depreciating every year. Every year the depreciation will be 10,000. How we got the 10,000? 100,000 divided by 10 years. The business is following again January to December as their financial year. So their first tax period is 1/1/2024 to 31st December 2024. On 1st January 2024, the market value of the asset is 120,000. 120,000 is the market value of the asset on 1st January 2024. Assets they have sold, let's number the facts what we are discussing. This is first one, the purchase. Second is life. Third is depreciation. Fourth is tax period. Fifth, we discuss the opening value, and we need to, or the market value as on 1st January 2024. Assets sold on 30th June 2025. And for how much they sold the asset? Asset is sold at 150,000 dirhams. 150,000. So these are the facts, and from this we are going to calculate how much will be the gain they will be getting excluded. Now, how much is the actual sale value? Sale value is 150,000 dirhams. We need to understand how much is the net book value of the asset. How we will work out the net book value? Net book value will be purchase cost minus accumulated impairment. Accumulated impairment for the intangible asset. We have a problem. Because if we calculate that the 2011 is the asset purchased and the life of the asset is 10 years, then the asset is already depreciated. So for the time being, to make this problem question correct, I am going to make, instead of 10 years the life of asset is, I am going to make 20 years. If the life of asset is 20 years, how much will be the annual depreciation? Annual depreciation will be 5,000 dirhams. How I got 5,000 dirhams? 100,000 divided by 20 years. So the annual depreciation is 85,000 dirhams. Now we are going to see, when they sold the intangible asset for 150,000 dirhams, what was the net book value? So from 2011 till which date they have held the asset? 30th June 2025. How many years it's already they have held this asset in the books? They have held the books in 14.5 years. 14.5 years is from 1st January 2011 to 30th June 2025. This is the date the property is sold. So 14.5 years is already the asset is used. That means that much depreciation we need to charge. How much will be the total depreciation? On cost we need to calculate 100,000 dirham is the cost into 14.5 years divided by total life is 20 years. How much will be the value? 100,000 into 14.5 divided by 20. The depreciation, accumulated depreciation is 72,500 dirhams. What will be the net book value? Net book value will be cost minus accumulated impairment. It's not depreciation, it is impairment. Cost minus accumulated impairment. Cost is 100,000 dirhams. Accumulated impairment is 72,500 dirhams. Net book value is 22,500 dirhams. We got the sale value, we got the net book value. How much will be the book profit? Book profit will be always sale value minus net book value, which is 150,000 dirhams minus 22,500 dirhams, which will be 127,500 dirhams. This is the book profit we have. Now from this we are going to calculate how much gain is excluded. And as we already discussed, this is intangible asset, so no direct method, only we have proportionate method. How to calculate the excluded gain? We need to see the sale value. How much is sale value? 150K minus hire of cost or net book value. How much is cost? Cost is 100,000. Net book value how much? 22,500. We got the net book value. Which one is higher? 100,000 dirhams. Then if we are minusing 150,000 minus 100,000, we are going to get 50,000 dirhams. 50,000 dirham is the gain. From this gain, we are going to see how many days the property they own prior to CT. If you are seeing they own the property from 2011 January to 11, 2011 to 31st December 2023. How many years they own it from 2011 to 2023 ending? They own this property for 13 years. Now, when it comes to intangible asset, what is the restriction we discussed? The maximum allowed is 10 years. This is the only difference when you are comparing to, see, when you compare the immovable property and intangible asset, there are two main differences. One, in intangible, you have only proportionate method. Second, in intangible, maximum period prior to CT, you can calculate 10 years. Now we are going to apply the formula. We got the gain which is 50,000 dirhams. So 50,000 dirhams into number of days prior to the CT. How much maximum we can take? 10 years. Even though it is 13 years, 3 years we need to exclude. That means 365 days into 10 years, it will be 3,650 days. How many days they hold the property from starting? What is the starting date? 1/1/2011. What is the sale date? Sale date is 30 June 2025. From this date to sale, acquisition date to sale date, how many total days they held the property? They held the property almost 5,658 days. When we are applying the formula, we are going to get 32,255. This 32,255 is the excluded gain. Excluded gain. From where we are going to minus this excluded gain? We are going to minus the excluded gain from the book profit. How much is the book profit? 127,500 dirhams. So the book profit is 127,500 dirhams. Excluded gain is 32,255. Then on what income they are going to pay taxes? CT payable on, or the taxable income is 92,245. This is how we need to calculate on the intangible asset. Method is same, only these two differences are there. Only proportionate method and maximum is 10 years. Now come the last category, which is financial assets and financial liabilities. Financial assets and financial liabilities. If a business has any financial assets, what are all the financial assets? It can be debt instrument or it can be equity instrument. We have discussed in IFRS which method they will be applying. They will be applying IFRS 9. If a business has a financial asset or financial liabilities, we need to see again here a slight difference from the previous two things what we discussed. Here we need to see how sale value, they sold the property, then minus the original cost. Now, what is the difference here prior to the what we discussed on the immovable property and intangible asset? In immovable property and intangible asset, we are telling higher of cost or net realizable, net book value. Here they are telling there is no such comparison. From your sales value, directly minus original cost. Directly minus original cost, then you are going to get the excluded gain. I'll give an example to you. If a business purchased a share in 2020, they purchased it for $100. They sold it in 2025 for $150. Now we need to see on the starting of tax period what was the market value of the shares what they were holding. They bought the shares for $100, and again they are following January to December as their financial year. So their corporate tax is going to start on 1/1/2024. On 1/1/2024, the market value of the share value, like will have a recognized stock exchange or something, and the market value of the share is, let's say, 120. 120 is the market value of the share. Now, how we will work out the excluded gain? We are going to calculate opening value. How much is opening value? Opening value is $120 minus cost. Here we are not getting the net book value. How much is the cost? Cost is $100. Now, what is the opening value minus cost? It will be $20. Now let's see how much is the sale value. The sale value of the share, they sold it in 2025 is $150. And are we going to see the net book value or something? No, we are going to see the acquisition cost. How much is the acquisition cost? $100. That means they are going to have a profit which is $50. From this $50, how much gain we can exclude? We can exclude the gain which is $20. How we got the $20? We took the value as on 1/1/2024 on the date the company subject to corporate tax, and we minus the acquisition cost. How much is the excluded gain? Excluded gain we got $20. Then how much will be the taxable gain? Taxable gain will be $30. This is how we need to calculate for the financial assets and financial liabilities. Now, let me give you a bit disclaimer on this particular chapter. This most of the companies are not going forward. This particular topic will not be relevant. Why it is like that? Because this was very much important in the first tax year. Now we are in 2026. Most of the companies are already filed the tax return for the first tax year. Who will not be getting this benefit? If the asset is purchased after CT, then they are not going to get this benefit. This benefit is mainly for giving as a relief to the business who had some assets prior to the implementation of corporate tax and they are going to sell it now. Then those who have not elected in the first tax year, let's assume if it is January to December, they have not elected. That means going forward, they are not going to get the benefit also. So the practical applicability of this transitional relief is almost gone. But yeah, since we wanted to cover the entire corporate tax, I'm just explaining this portion. I'm not going to open the Ministerial Decision 120 and Article 61 and explain these things because it is less relevant, honestly telling. So, but yeah, good to keep in your mind, yes, this transitional relief was applicable. And I personally know so many companies missed to elect it. That is a different story. They were not aware about this transitional relief and they forgot to elect. Now the situation is that it is irrevocable and it is first tax return, whatever it is elected, that is there forever. It is not going to be changed. What we discussed in summary, it's a asset should be in cost model, holding prior to CT, sold or in expecting to be sold after CT, and election. Election is irrevocable. And we discussed about asset. When it comes to immovable property, we discussed two methods, direct method and proportionate method. Direct method, we are approaching a valuer and getting the opening value and calculating the excluded gain. We have seen the sample calculation. Proportionate method, we are not going to any approved valuer. We are calculating based on number of days the property held prior to implementation of CT and total number of days the property held from the starting till the day the property sold. We saw the sample calculation. Then when we move to intangible asset, the treatment is more or less same as immovable property. There are only two differences. One is only proportionate method. There is no direct method for intangible asset. Second thing, if the assets they were owning prior to CT more than 10 years, maximum they can consider 10 year only. Then the third we discussed on the financial assets and financial liability. Here the difference is that it's always on original cost. There is no net book value. How the gain need to be calculated? The sale value minus original cost. On the opening day of the corporate tax, how much was the opening value minus cost? That is our excluded gain. Then on the actual profit, book profit, we can minus the excluded gain. So this is about the transitional relief. This is about the transitional relief. Now in next chapter, we are going to discuss allowable and disallowed expenses. This is very important, and this not like transitional relief. This has an applicability as long as the corporate tax law is there. What are all the expense allowed under corporate tax? What are all the expenses disallowed? Certain expenses are partially allowed, certain are partially disallowed. We are going to discuss it in detail in chapter 17, and we will see once we discuss allowable and disallowable expenses, practically how business need to make this adjustment. We will see a practical question also in the future chapter. See you in the next chapter. Until then, bye bye.